Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Qualcomm and NXP stocks so we can determine if it's a buy or a sell. First, we're going to do Qualcomm. Let's get started with the model. This is a large cap company, 126 billion market cap. They're trading at 113 a share, and they have 1.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have low free cash flow in 2020 due to low revenue from COVID. It was 4.4 billion. It nearly doubled the following year to 8.6 billion. Then it dropped to 6.8 billion in 2022. And it's pretty steady after that, 6.9 billion in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that more than doubles from 2020, 5.2 billion, to almost 13 billion in 2022. It's still pretty high in the trailing 12 months, 10.6 billion. Revenue is a sales for the company, and that nearly doubles from 2020 to 2022. It drops a little in the trailing 12 months to 41 billion. Here's their latest income statement in the first quarter of 2023 versus the first quarter of 2022. Revenue is down from 11.2 billion to 9.3 billion. And their revenue in both equipment and services and licensing are down. Equipment and services last year was 9.4 billion, now it's 7.8 billion. Last year, licensing of 1.7 billion, now it's 1.4 billion. Let's try to get a breakdown of the revenue so we know what it is. Of the 9.3 billion of revenue, 8 billion is QCT. That stands for Qualcomm CDMA Technologies. This is where they develop and supply integrated circuits and software. And that's to be used in mobile devices, wireless networks, Internet of Things, etc. QTL is 1.3 billion. That stands for Qualcomm Technology Licensing. That's where they license their technology to other companies. All the costs directly tied to generating the 9.3 billion of revenue is 4.2 billion. That's their cost of revenue. That includes cost of materials, supplies, payroll. Then you have R&D, research and development, 2.2 billion. R&D in the first quarter of 2023 is 2.2 billion, or 24% of their revenue. Last year was only 18% of their revenue. So they're spending a lot more on R&D as a percent of revenue. The increase was due to 106 million of SBC, stock-based compensation, plus expenses of 33 million related to the development of wireless and integrated circuit technologies, driven by an increase in employee-related expenses. Below that is SG&A, selling, general, and administrative expenses, 600 million, down a little from last year of 624 million. Even though the dollar amount of SG&A went down from last year, it's still more as a percent of revenue since revenue went down even more. It's 7% of revenue this year. Last year was 6%. Then you have other of 200 million. The 200 million was related to restructuring costs, pretty much all of which is related to severance. So severance packages for its employees. Total expenses 7.2 billion. Operating income 2.1 billion, down a lot from last year of 3.9 billion. Interest expense 179 million, up from 137 million. And they had net income of 1.7 billion, down from 2.9 billion. EPS of $1.53, down from 261. And they did decrease their shares outstanding. Last year they had 1.125 billion. Now they have 1.116 billion. Let's look at the capital structure. 20 billion of equity, 16 billion of debt. They're 55% equity, 45% debt. Their net debt is 9.3 billion. So they have about 6.5 billion of cash on their balance sheet. I gave them a WACC of 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 155 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $136 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of 122. They're trading at 113, so they're trading at an 8% discount. It's a buy according to the model. Let's look at the stock on Simply Wall Street. It's trading at 113, 126 billion market cap, down 11% in the past year. Qualcomm develops and commercializes foundational technologies for the wireless industry. Here's some of the risks. Earnings are forecast to decline by an average of 5.5% per year for the next 3 years. Has a high level of debt. Here's the stock price historically. It looks like it started trading in 1992. Its highest stock price was 186, and it hit 186 in January 2022, so about a year and a half ago. That was its highest point ever. So it's down about 30% from the peak. Simply Wall Street's valuation is 131. They say the stock is 14% undervalued. 25 analysts price this stock and the average price target is 135. They say the stock is 19% undervalued. Their trailing 12-month revenue in 2012 was $19 billion. It hit $28 billion in the first quarter of 2015. And for the next 5 years, the revenue was pretty much flat. It never broke through $28 billion until the first quarter of 2021. The trailing 12-month revenue was $29 billion. In the third quarter of 2022 was its highest revenue, $44 billion. Their revenue has regressed a little bit the past couple of quarters, but still over $40 billion, a pretty big number. You can see they were debt-free in 2013, 14, and 15. Then they started adding debt. It peaked in 2018 at $22 billion. Their debt has come down a bit the past few years, but their equity is up a ton the past 3 years. Dividend of 2.8%, payout ratio of 32%. The way you calculate the payout ratio, it's dividend per share over earnings per share. They can cover their dividends with their earnings 3 times. Their average industry dividend is 1.1%, so they're well above that. You can see they raise their dividend each year. In 2012, they only paid $1 per share. And the forecast is for them to pay $3.30 per share by 2025. The yield is a little more volatile because it moves with the stock price. A yield of 1.7% in 2012. It hit 4.5% in 2018. And the forecast is for the yield to hit 2.9% by 2025. The CEO's annual salary is $1.1 million. Total compensation package, $4.8 million. And there's been no insider buying in the past 12 months, just sells, 2 sells by the same person. 75% of the company is held by institutions, 25% by the general public. Vanguard is their biggest shareholder at close to 10%. They have nearly 110 million shares valued at $12.5 billion. A good sign is when a company's employee count goes up each year. Their employee count went up from 27,000 in 2012 to 51,000 in 2022. They trade on the Nasdaq, Mexican Bolsa, Deutsche Börse, Xetra, Santiago Stock Exchange, Swiss, EuroTLX, Wiener Börse, the Lima Bolsa, Bulgaria, Kazakhstan, BATS Europe, Buenos Aires, and the Sao Paulo Bolsa. The next company we're going to look at is NXP. Based in the Netherlands, they started in 2006. Let's get started with the model. This is a large cap company, 49 billion market cap. They're trading at 189 a share, and they have 259 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow is pretty steady. 2 billion, 2.1 billion, 2.7 billion, down to 2.5 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's low in 2020, 2 billion in 2021, jumping up to 2.8 billion in 2022, down to 2.8 billion in the trailing 12 months. Revenue is a sales for the company, and that grows nicely from 8.6 billion to 13 billion. It's pretty much flat from 2022 to the trailing 12 months. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. Revenue is pretty much flat, 3.1 billion. Let's try to get a breakdown of the number so we know what it is. Of the 3.1 billion, 1.5 billion is from distributors, 1.6 billion from OEM, original equipment manufacturers. Here's another breakdown of their revenue. Of the 3.1 billion, 1.8 billion is automotive, so that's their bread and butter. $500 million from IoT, 260 million from mobile, and 500 million from communication infrastructure. And the reason their revenue is flat is because it's up 17% in automotive. It's down a lot in IoT and mobile. Of the 3.1 billion, 947 million from China, 975 million from all Asian countries excluding China, EMEA 725 million, and America is 474 million. So they are pretty reliant on China. That makes up a good portion of their revenue, which went down 11% from last year. EMEA is up 13%. All the expenses directly related to generating the revenue is $1.4 billion. So their gross profit, revenue minus cost of revenue, is $1.8 billion. R&D, $577 million. Their R&D makes up 18.5% of their revenue. Last year was 16.5%. And the reason for the increase is higher personnel costs, higher restructuring costs, minus lower variable compensation costs. Below that is selling, general, and administrative expenses, $280 million. And that's 9% of their revenue. Last year was 8%. The changes in SG&A were higher legal expenses, higher personnel costs, higher restructuring costs, minus lower variable compensation costs. Then you have $85 million of amortization, so total expenses $942 million. Operating income $825 million, down from last year of $873 million. Their net income $623 million, down from $666. So their EPS, earnings per share, is $237, down from $250. They did decrease their shares outstanding. They had 263 million last year. Now they have 260 million. Let's look at the capital structure. 8 billion of equity, 11 billion of debt. They're 42% equity, 58% debt. Their net debt is 7.2 billion. So they have 4 billion of cash on their balance sheet. I gave them a WACC of 10.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 55 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $48 billion. We divide that by 259 million shares. And we get a calculated stock price of 183. They're trading at 189, so they're trading at a 3% premium. It's a sell according to the model. There are 62 companies in the same industry as Qualcomm and NXP. And if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Qualcomm spends about $2 billion in CapEx, NXP $1 billion. The average is $1.7 billion. They both have a higher debt-to-equity ratio than the average company in the industry. NXP is a little more leveraged at 1.4. Qualcomm is 0.8. They both pay strong dividends. Qualcomm is higher at 2.6%, NXP 1.9%. Intel pays the highest 4.4%. That's mainly because the stock price has declined so much. But I have a feeling they're going to cut their dividend. Maybe not suspend their dividend, but reduce it. Because they are bleeding money, Intel. Look at their free cash flow, negative 20 billion. Qualcomm generates 6.9 billion of free cash flow, NXP 2.5 billion. Qualcomm is higher than Intel, Texas, and AMD. Also higher than the king, NVIDIA. Qualcomm ranks 7th in market cap at 126 billion. NXP 49 billion, they rank 11th. They both have a price to book worse than the average, but they both have really good PEs. Better than the median, and of course a lot better than the average. Because the average is really inflated by NVIDIA and AMD. Price to free cash flow, they look great as well. Qualcomm is a little better. Qualcomm is a really good price to sales, 3.1. NXP 3.7, a lot better than the average, a little worse than the median. They both generate more revenue than the average and median. Qualcomm over 40 billion, which is a lot higher than NVIDIA. And Qualcomm's growing, 13% 5-year annual revenue growth rate. NXP is only 7%. Let's look at NXP on Simply Wall Street, trading at 189, 49 billion market cap. The stock is up 19% in the past year. Their description is NXP Semiconductors offers various semiconductor products. Not much of a description. Here's some of their risks. High level of debt, unstable dividend track record, significant insider selling in the past 3 months. It looks like they started trading in 2010 and their price peaked at $233. They hit that $233 mark at the very end of 2021. They had a really big run up post-COVID and the stock has been regressing the past year and a half. Is it due for another push? It could be. Simply Wall Street values the company exactly where they're trading at. 26 analysts price this stock and the average price target is 200. They say the stock is 6% undervalued. Their trailing 12-month revenue in 2012 was $4 billion. 4 years later in 2016, it doubled to $8.7 billion. And now it's over $13 billion currently, so their growth is phenomenal. It seems like they've always had some debt. In 2012, $3.8 billion. It jumped up to $9 billion in 2016. They did reduce their debt the next few years, but now it's at its highest level at a little over $11 billion. And their debt is a little higher than their equity. They pay a dividend of 2.1%. The industry average is 1.1%. Their payout ratio is 34%, which means their EPS is a good amount higher than their dividends per share. EPS of $10.57, dividends per share of 4. You can see they do raise their dividend each year. It was $1 per share in 2018. The forecast is for the dividend per share to be $4.70 by 2025. This is annual dividends for the entire year. And their yield was 1.2% in 2018. It's over 2% currently. The forecast is for the yield to be 2.5% by 2025. There's been no insider buying, just 2 sells, both in May by different people. 93% of the company is held by institutions and 7% by the general public. Fidelity is the biggest shareholder at 9%, 23 million shares valued at $4.5 billion. They had 26,000 employees in 2012. It was up to 44,000 in 2015. They must have divested or sold off part of their business because their employees now are 35,000. The ticker trades on the Nasdaq, Deutsche Börse, Xetra, Mexican Bolsa, London Stock Exchange, Wiener Börse, EuroTLX, and Sao Paulo Bolsa. So let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.